Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Eid Mubarak to you and your families. I hope you had a great Eid break. Alhamdulillah, ours was good. I've just taken a couple of days off work and just focusing on family and so on, so it's been good, Alhamdulillah. And now I've got a little bit of time, so inshallah in the next couple of days I've got a few videos that I plan to share with the community, and that's exactly what we're going to do. But before we do that, I just, as always, if you can join us at the Patreon account, it makes a huge difference to the to me, and of course it helps us of course to pay for a lot of the subscriptions and things like that we have. And this is the portfolio, as you can see here, for last week. It has been up about 1% or so, but overall we are heading the right direction. As you can see, this is the how much we're up, about 7% right now, or 7,800, or closer to 8,000 pounds overall. A lot of companies basically have done well over the last couple of weeks. I'm not going to get into that, just looking at, I'll be doing a portfolio update basically soon, inshallah, so I'll share that with the community. But as you can see, Broadcom is still on top when it comes to that gains, despite having a 4% down a couple of days ago. And I'm not really worried about that company. It's been absolutely amazing. I will probably do a video on that company very soon, because they've just reported, and I want to see if it's still undervalued, overvalued. Share that with the community, inshallah. I've got loads of videos planned, including ETFs and so on, so stay tuned for that, inshallah, for the next couple of days. As you can see, the S&P 500 in the last 5 days is basically up about 2%. The Dow Jones is almost 2%. The Nasdaq more or less similar. FTSE 100 is doing decent. I like, even for the 1 month, everything is in the green. For the last 6 months, we are almost in the green, basically, with the S&P 500. And the Dow Jones is about just less than 4% down for the year to date. So since January up until now, everything is now in the green, including the Dow Jones, which is very interesting. But look at the FTSE 100. It's done absolutely amazing, 7%. I hope that it continues doing that, because it's about time the UK companies actually do better. Not better than the US in general, but do at least that 7 to 10% total basic return on investment, and hopefully that will continue in the next whatever years. Now let's look at these 10 companies. What I basically plan for us today is to look at basically 10 high quality businesses, and how I define high quality businesses in these terms are two things. We're looking for companies that have a wide moat, so all of them apart from one has a wide moat. And the most important thing for today is the companies that we're talking about are called basically cash cows. And these are companies that have an excellent free cash flow. Now, we are using the free cash flow margin of, a higher than 30%. So we're looking for 30 or more, okay, free cash flow margins. And what is a free cash flow margin? For free cash flow margin is a financial ratio that measures how efficiently a company converts its revenue into free cash flow. And we know what free cash flow is. Free cash flow is the money that companies basically have after they paid for all the expenses, capital expenditure and so on. All of that is paid, is the money that's left. And that money is used to pay any debt the company has, buying back their own shares, paying dividends, reinvesting in the company and growing the companies, acquiring other business. There's a lot of things they can do with the free cash flow. So companies that generate free cash flow are generally, what they're doing is they take in the portion of the revenue and converting it to free cash flow after they paid for everything else. That means to me, these are companies that are very much profitable and doing absolutely amazing job, and management should be applauded for that. So that's the companies that we're looking, the type of companies that we're looking at today. And to have, normally, investors say about 15% is basically really good. But today, what we're going to look at the companies that have a 30 or more percent. Okay, that's exactly what we're looking at today. And I'm not going to go into more details of each one of the companies. If you're interested, of course, you could do a little bit more research on each one of the companies. And as I always say to you guys, this is no financial advice. Don't go and buy some of these companies. Some of them are actually very much overvalued right now, but we are talking about them today because they are high quality businesses and you might get a chance at some point. So put them in your watch list and leave them alone. Okay, so let's start with the first company, and that is ASML. I've taken out all the dividends side of things. We're not focusing on dividends in today, but we are focusing more of the companies that have a wide moat, as well as the companies that have excellent free cash flow. And as you can see, this company has a 290 3 billion market cap. It has a wide mode, currently trading $753 per share. The company has excellent profit margin, return on equity, and return on invested capital, probably one of the best out there. Free cash flow right now, we're looking at over $10 billion. Now, free cash flow margin of 30%. And by the way, we are ranking this company, so the top end is basically 30 all the way to, I think it's about 50. Some of the, company number 9 and number 10, they are probably in about the 50s, if not more, which is absolutely amazing to know. EPS growth expected to be about 33%. Revenue is expected to be about 25%. And Morningstar is saying right now it's about 7% upside from where we are. Their price is $960 per share. That's where they think the company should be. Now, the next one we're looking at today is Salesforce, another company that has about 33% free cash flow margin, which is absolutely amazing. Now, as you can see here, it's a huge company, 252 billion market cap. I've always said to you guys, this company is probably one, that's going to be similar to Microsoft in the future. So let's see how that develops over the next whatever years. The company still has a wide mode. Profit margin, return on equity, return on invested capital is decent. The company has become, very much profitable over the last whatever years. And it has over $12 billion of free cash flow right now. So 33% of free cash flow margin is absolutely amazing. They're expecting the earnings to grow about 11% next year. Revenue about 9%. Morningstar is saying it's about 15% upside from where we are. $315 per share is where they think the price should be. The next one we're looking at today is FICO. Apologies for my voice, is just like a little bit all over the place this morning. FICO, basically, or Fair Isaac Corporation, is basically and has a market cap of $52 billion. And as you can see here, it has a free cash flow margin of 37%. Now, in terms of actual cash they have, I would have liked the company to have a little bit more, but they do actually have a much higher free cash flow margins. But this should be at least a couple of $1 billion for a company that has a market cap of $52 billion. That should be in the billions at least. But when it comes to price wise, basically the valuation for this company, it seems overvalued about basically 10% right now. So you probably would have to wait for this company to come down quite a bit. I wouldn't actually touch it until at least it hits maybe 15% or lower than where it is right now. But they're expecting the earnings, a lot of these companies really genuinely have a very high growth expectation for the next couple of years. And this one is basically 23 for when it comes to EPS, revenue about 15%. The next one that we're looking at today is S&P Global, another company that I own in my portfolio. 38% when it comes to the free cash flow margin so far, over $5.5 billion of free cash flow. Great company overall, 4% upside from where we are right now. Earnings expectations and revenue is not the best, but it's decent so far. Another great company that seems basically undervalued at the moment, or even fairly valued. The next one that we're looking at is Adobe. Despite the stock being down so far, this company is still one of my favorites out there. 176 billion market cap. It has a wide mode, $416 per share. Profit margin, return on equity, return on invested capital is still one of the best out there. 30%, 47% and 32% is absolutely amazing. Free cash flow right now, we're looking about over $9 billion and 42% free cash flow margin, which is absolutely ridiculous. They're expecting the earnings to grow by 11%, revenue to grow about 9%, 42% up, basically upside from where we are. $590 per share is the way they think the price should be. Honestly, this is probably one of the best basically opportunities in the market right now for a great company. Yes, there is a bit of a question mark with regards to basically AI and what it's going to do, but the company is trying to diversify also within their product and creating basically some AI basically features within their technology, within their device software and so on. So we'll see how it goes over the next couple of years, but this company is not going to run out of business because they do have excellent free cash flow. They do have a lot of money. The company is growing fast, and the next couple of years they can diversify away from maybe some of their legacy software into more AI driven software. So I wouldn't be surprised. Next one is MSCI, another one that I own in my portfolio, closer to $4 billion. It has a wide mode, $568 per share right now. Profit margin is about 40% right now. Return on equity is not there because the company has a more current liabilities than current assets, so that's probably one of the reasons. Return on invested capital 33%. Free cash flow right now we're looking at about $1.3 billion, but free cash flow margin of 47%, which is absolutely amazing. They're expecting the earnings to grow about 10%, revenue about almost 8%. Morningstar saying it's basically overvalued about 5% right now. We'll probably add another 5%, and then maybe just basically if it comes down maybe 10%, I'll probably will be looking at it again. The next one is one of my all-time favorites, and that's MasterCard. And this one has a 532 billion market cap, wide mode, $590 per share. You will not find any companies like this anywhere in the market. Look at this, 45% when it comes to profit margin. Return on equity 188%. Return on invested capital 52%. $14 billion of free cash flow, 49% when it comes to the free cash flow margin right now. They're expecting the earnings to grow about 9%, revenue about 13%, but it is expensive right now, so I wouldn't touch it. 500 is where they think the price should be. It's 590. It probably needs to come down quite a bit to be able to be in that sort of range. I'll probably add if it comes down maybe another 20% or so, I'll probably add to it. NVDA is the next one. Look at this one, 3.4 billion market cap, trillion market cap, wide moat, $141 per share. Look at this out. This is probably why this is one of the reasons why the company is so expensive. But look at this free cash flow, $72 billion. Like, that is bigger than some of these companies here. It's bigger than this one. Basically, the free cash flow they have is basically way more than some of these companies that we talked about today. It's absolutely ridiculous, and almost 50% when it comes to free cash flow margin right now. This is why the company is so crazy and so expensive right now, if you think about it. And they're expecting the earnings to grow about 43%. This is why people are paying so much money for this company right now. Revenue is about 53%, 12% upside downside from where we are right now. So it's expensive right now. It needs to come down maybe at least to 15 to 20% to actually be attractive again. $125 per share is where they think the price should be. Right now we're looking at about 140 something. The next one is AppLovin Corporation, another company that's in tech side of things. As you can see there, 151 billion market cap. This is the only one that has a narrow economic mode. $417 per share right now. 37% when it comes to profit margin, 287% when it comes to return on equity. Return on invested capital 44%, and free cash flow right now $2.5 billion, and that's about 51% free cash flow margin, which is absolutely ridiculous. Remember what I was saying earlier, normally people kind of recommend companies that have like free cash flow margin about 15% or so. That's a good one. But look, every single one of these companies has 30 or basically to 50 plus. And EPS expected to grow 78%, which is absolutely crazy. And revenue is expected to grow about 21%, but it is quite expensive, 27% when it comes to the Morningstar valuation. So that means it is quite expensive right now. I wouldn't touch it anytime soon. But the reason why it's so expensive is because of these growth expectations. That's why a lot of people are putting a lot of their money into this company, because they know how much it's going to grow. Now, anything can happen. This can easily change. Remember, this is an estimate. But if that comes through, this is, of course, taking that bit of a risk is not bad. But 27% basically downside from where we are, or basically 7% is basically a bit too much, I would say. Finally, Visa. Look at this company. When it comes to the free cash flow margin of 58%, probably one of the best companies out there, one of the best companies that I've actually ever owned in this portfolio. $20 billion of free cash flow. That's second highest when it comes to basically what we've seen so far after NVDA. Like, it's probably one of the best companies that I've actually ever owned. MasterCard is almost the same, but this Visa has always been like my top holdings for quite some time. And as you can see, they're expecting the earnings to grow about 13%. Revenue is expecting about 10%. It is expensive right now, so I wouldn't touch it. If the market comes down again quite a bit, just like what we had in April, potentially look at it again. Now, every single one of these companies is very high quality businesses. Some of them are expensive, some of them are cheap right now. But what you should be doing as a long-term investor is looking in these companies and actually adding some of them to your portfolio. Not every single one of them, but some of those companies you should own. Just to be honest and transparent with you guys, I do own, the only one that I don't own is Fair ISA Corporation. I don't own the APPL. That's it. The rest of them are in my portfolios, either the family portfolio or this portfolio that you've seen me share with you guys. Visa is one of my top holdings. S&P Global is another top holdings there. MasterCard is in there. ASML is in there. NVDA is in there. Salesforce is in there. MSCI is also in there. So a lot of these companies, I'm not just sharing with you guys because I own them. It's because the numbers add up. And this is basically free cash flow margin that is not going to lie to us, okay? This is what they have. This is the margin of that. And this is the growth expectations. And again, a lot of these companies have a wide mode and they are huge companies for a reason. So if you're interested in it, basically this type of research and all of that stuff that takes, I do normally, just join us in the Patreon account, inshallah, and I will share more information about these companies and so on, where you also get basically access to the family portfolio and things like that. With regards to Sharia compliant, just post the video, have a look at it. Every single one of these companies Sharia compliant based on Zoya, Sharia compliant, and these are the standards that we're looking at. There might be other websites where some of these companies might not be Sharia compliant for whatever reason. I just use Zoya. It's been great to me. They have actually updated quite a bit. I have no affiliation and never had a contact with them apart from it here and there where I needed something from them with regards to basically asking them questions about things. I have no affiliation or anything like that. So I hope you're enjoying the content. I hope you're enjoying transparency and so on. All I ask is if you can join us on Patreon account, like the videos. If you can't, subscribe to the channel, share it with your family and friends, and let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.